Stan Shamu from IG Markets in Melbourne. Stan, great to have you on board. Maybe start risk currencies breaking out of a recent range overnight. We're continuing to see a bit of appreciation in terms of the Aussie dollar. Your thoughts?
Yeah, absolutely. We did see this move just basically triggered overnight. Of course, we had seen some fairly tight ranges of the Asian session yesterday, but with the market anticipating some fairly positive outcomes from all the key headline risk events that we've got this week, it certainly does seem like risk currencies will remain fairly bid into, particularly into the FOMC decision. Of course, we've got that German constitutional ruling later today, but that's widely expected to pass. The only issues might be integration of the bailout funds and conditions for future bailout funds, and unless we get some negative tone around that, we are likely to continue seeing the euro push higher. Of course, the single currency has also been supported by some sort of short covering. Of course, there were a lot of shorts starting to unwind above that 128. It certainly seems like it's still quite bid. We've got the Aussie dollar as well pushing back above that 1.04 level. Of course, this morning it was sort of flatlining, but following that consumer sentiment data, it seems to have pushed a bit higher once again. Last I checked, it was retesting the highs from overnight. I think that was around 1.045. So it certainly seems like the momentum's to the upside. It also helps when you start getting some positive rhetoric from China. Of course, we've been having this going for a while, so I'm sure some of the skeptics out there would say, hang on, we've heard this before. They continue to obviously commit to this growth target. Of course, they also have that extra 100 billion yuan for funding, and this might be tapped into to boost growth going forward. We got that reaction as well in iron ore prices, and obviously we're back above that $100 mark. So it certainly seems like the markets are responding to all the efforts that we are seeing by officials across the world trying to reignite growth.
It seems also a fair bit of US dollar weakness driving it at the moment in terms of some of the risk currencies. I think 4-month lows against a basket of those risk currencies. Look, potential for the greenback to have been oversold. I mean, there are still plenty of question marks over, the global environment moving forward.
Yeah, at the moment it certainly doesn't seem like it's been overdone. Of course, we also had that Moody's headline suggesting that unless the US does something about its debt to GDP ratio, then we could see a downgrade around the corner. And because they probably don't want to compromise growth at the moment with those grave concerns surrounding the jobs market. So this could be a theme that could continue for a while, particularly if we continue seeing the US having to open the taps to continue boosting growth.
And in terms of equities, obviously we've got off to a pretty good start at the moment on our market. Your thoughts for the rest of the session?
Yeah, well, I think we'll continue to see the materials space drive the gains. I mean, obviously, they've come back to life after recent underperformance. So with stocks like BHP at those sort of levels and Fortescue, I mean, obviously last week tested those lows below $3. It certainly seems like we will continue to see that buying ramp up in that space. Of course, iron ore prices are likely to gravitate back to that $120 per ton mark, and that would definitely appease some investors. We also have the gold space increasingly becoming interesting because of further easing ahead, supporting gold prices. So this probably will continue for the rest of the week, this theme of seeing the miners coming back to life, and probably the defensives will underperform as money rotates out of those sectors.
Read on volume so far this morning, Stan?
Well, look, the participation remains fairly benign, so it certainly seems like we're growing up on limited volume. We'll probably have to wait and see once all these key headline events are erased and see if we can get a pickup in volume.
Thanks, Stan Shamu from IG Markets in Melbourne. Appreciate that.
Thanks, Brooke.
Consumer sentiment is showing some signs of life, but is still weak by historical standards.
The Westpac Melbourne Institute Index is...
So clearly it doesn't fit into that sustainable and substantial number.
So you're saying he's just basically fed up now. He's had so many of those lukewarm prints. He's saying, to hell with it, I've got no other option but to dump.
Well, why would he wait? I mean, why would he wait till January and December to do it? Then September, okay, you've got the political aspects, but that potentially plays into this meeting. But he looks at the long-term picture now. if you look at that 6-month average that I just spoke about, it's just it kind of says to me that the next 2 months are going to be pretty soft as well. There's no real reason, if he's looking at the long-term projections, and given that core PCE is still below his 2% target as well, there's no real reason for him to wait. September should be the month that he does this. He's given enough indications with his hard-hitting, grave concerns words. So I think that's the issue. But going back to your original point, there are clear differences between now and 2009. I mean, if you look at the market, there was disinflation. People were really worried. So he had to come and stimulate to create that reflation trade. At the moment, inflation's not a particularly strong point, but he doesn't need to be concerned about it either way. And I think your stock prices were obviously a lot lower, even though that's not part of their mandate. And I think the big issue, the big difference between 2009 and now is liquidity. I mean, there's clearly excess liquidity still in the system, whereas in 2009 there was no liquidity, credit was dry. And I think that's what some of the sort of QE3 bears are saying, you know, that is the major differences. But Bernanke's made it categorically obvious that he is really worried about employment, and that employment rate at 8.1% showed the lowest participation rate in about 30 odd years. So to me, if he's going to do it, he should do it in September, regardless of whether there's an election in place, rather than wait to December to January. And I think he's built a massive rod for his back in just his commentary that something really should happen sooner rather than later.
Indeed, will all be revealed very soon, and we will talk soon.
Well, despite the overnight bounce in iron ore, as we've just been talking about with Chris, it's still a relatively low price, and it could still cost Australia more than $15 billion in export revenues and punch a $3 billion hole in the federal budget.